All right. Um, Welcome back to the deep dive. And if you're listening to this right now, I honestly hope you're sitting down.
Yeah, you really might want to take a seat for this one.
Seriously. I hope you found a quiet corner somewhere.
Mhm.
Maybe dim the lights a bit. And honestly, you might want to have a beverage of choice in hand.
Make it a strong one.
Right, exactly.
Hmm.
Because if you looked at your portfolio today, if you dared to even open that brokerage app on your phone,
Yeah.
you probably need a drink.
It was visceral. That is, I mean, that's really the only word for it today. Visceral.
Yeah.
It wasn't just a red day on the screens. It was a sea of red. It's the kind of day that makes you question your life choices or, at least your asset allocation strategy.
Completely.
Yeah.
So just to set the stage for you guys listening, it is Monday afternoon, February 23rd, 2026.
Right.
The closing bell just rang a few minutes ago. And we are just sitting here staring at the wreckage. So let's just rip the Band-Aid off right away with the numbers so we can move on. Because we really have a lot of work to do today.
Let's hear it.
Okay, so the Dow Jones Industrial Average plummeted over 800 points today.
Brutal.
800. That's about 1.7% of total value just vaporized in, what, 6.5 hours?
Just gone. Yeah.
The S&P 500 is down a full percent.
Yeah.
And the NASDAQ, which, usually leads the charge on any kind of recovery, is down 1.1%.
And, the context here is just, it's everything. Because if you rewind the clock just 72 hours, go back to Friday afternoon, we were popping champagne.
Exactly. We had the Supreme Court rally.
Right.
Everyone thought the coast was completely clear. And today just feels like the most brutal hangover in market history. But, and I want to stress this to everyone listening, this is why we're here. This is why we call this the Theta Fuse Deep Dive.
Yes.
Because you take a step back from the panic. This is exactly the environment we wait for.
It is. Because, look, the amateur looks at the red numbers and they just panic. They sell.
They hit the market order and close their eyes.
Right. But the professional looks at those same red numbers and asks, okay, where is the dislocation? Where is the mispricing? Because today was a classic Theta Fuse scenario.
A Theta Fuse. I absolutely love that term. But for the listeners who might be a little new to the terminology, maybe just set the stage a bit, why aren't we just crying in the corner right now with everyone else?
Because volatility is opportunity. It's really that simple. When the screens turn red like this, implied volatility or IV spikes.
The fear gauge.
Exactly, the fear gauge. And when fear is high, the market charges a massive premium for protection. Options become incredibly expensive. So if you're a buyer of options today, it's a nightmare. You're completely overpaying for insurance on a house that's already on fire.
Right.
But if you're a seller of options, if you are willing to step in and provide liquidity when everyone else is running for the exit doors, the premiums right now are incredibly juicy.
So while the retail investor is just panic selling at the bottom, the strategic investor is looking at the options board and saying, who wants to pay me to take their fear?
Precisely. Today was a bull trap, plain and simple. Friday was the setup. Monday was the trap.
Yep.
But inside that trap, there are massive structural dislocations that we can actually trade. We aren't just here to report the bad news. We're here to figure out how to monetize the chaos.
I love it. Monetize the chaos. And man, do we have a lot to unpack today to do that. It feels like 3 completely different hurricanes just collided over Wall Street all at once.
It really does.
You have a macro rug pull with these new tariffs, which, by the way, are just wild. We'll get into that. We have this sudden existential panic in the AI sector, thanks to that Citrini note.
Oh, yeah, that was a bloodbath.
And then we have a very ominous warning from the Treasury Secretary about private credit.
It's the perfect storm, and yet sitting right in the eye of that storm perfectly calm is Nvidia.
Yes.
Reporting earnings on Wednesday and trading at a valuation that honestly just doesn't make any sense right now.
It's the most bizarre setup I've seen in years. So the mission for this deep dive is pretty simple. We are going to look way past the 800-point drop. We're going to figure out where the actual structural breaks are and where the market is just freaking out over ghosts.
Let's get right into it then.
We got to start with the macro, the tariff bull trap. Because this is the thing that flipped the sentiment on a dime. This is the reason the futures were bleeding red before anyone even brewed their coffee this morning.
Right.
So walk us through the Friday versus Monday dynamic. Because I know a lot of people feel like they just got severe whiplash.
Okay, so let's go back to Friday afternoon. The Supreme Court issues a major ruling. They strike down President Trump's use of IEPA.
And IEPA is the International Emergency Economic Powers Act.
Right. He was using IEPA to justify his blanket emergency tariffs.
And the market interpreted that Supreme Court ruling as, ding dong, the witch is dead. tariffs are illegal, the trade war is over.
Exactly. The algorithms basically just read the headline, "Tariffs struck down," and they bought everything in sight.
A massive relief rally.
A huge one. The assumption across the street was that the administration would have to go completely back to the drawing board. They'd have to go to Congress, they'd have to actually draft legislation, debate it in committee.
Which takes months, sometimes years.
Right. So everyone thought we had a reprieve. The threat of immediate tariffs was gone.
And then came Saturday morning.
Then came Saturday. The president didn't go to Congress. He didn't concede defeat at all. He just went to a different shelf in the legal library and dusted off Section 122 of the 1974 Trade Act.
Section 122. I swear, I feel like I need a law degree just to keep up with the economy these days. It sounds like something out of a terrible tax audit nightmare.
It really does.
What makes Section 122 so different from IEPA? Why is he allowed to use this one?
It's a completely different legal mechanism.
Yeah.
See, IEPA is about national security emergencies. It was designed for things like sanctions or blocking terrorist financing. So using it for broad economic tariffs was always a really massive legal stretch, which is exactly why the Supreme Court struck it down. Section 122, on the other hand, is purely economic.
Oh, interesting.
Yeah. It explicitly allows the president to impose temporary import surcharges to deal with, and this is the exact key phrase in the law, large and serious balance of payments deficits.
Well, if you look at our current trade deficit numbers, we certainly check that box.
We absolutely do. So legally speaking, he is on much firmer ground here. He doesn't need to try and prove some vague national security threat. He just needs to point at the massive trade deficit.
Right.
But the result for the market is that we went from tariffs are gone on Friday to here is a global 15% duty on everything for 150 days on Monday.
A global 15% tax. Are there any exceptions?
No exceptions. And this is where the details get completely fascinating and honestly why the market puked today.
Lay it out.
Section 122 is a really blunt instrument. It wasn't designed for surgical geopolitical precision. It has a specific clause in it requiring the tariffs to be non-discriminatory.
Non-discriminatory, which, sounds fair. Like in normal everyday life, being non-discriminatory is a good thing. It means everyone gets treated equally, right?
In normal life, yes. Right. In trade war strategy, it's an absolute disaster. It means you cannot pick and choose your battles. You can't say to the UK, hey, we like you, you're an ally, so you pay 0%, but we're fighting with China, so they pay 60%.
Right, I see.
Yeah, Section 122 forces a flat rate across the entire board. If you tax one country, you literally have to tax them all.
And that created that bizarre inversion regarding the winners and losers today. Yeah, I was reading the note from Capital Economics this morning, and I actually had to read it twice because the math seemed completely backward.
It is backward, especially compared to the last few years of trade policy. Think about our allies for a second. The UK, Australia, Italy. Right. These countries just spent the last year negotiating these complex friend-shoring deals with us. They made domestic concessions. They opened their own markets to U.S. goods.
They played ball.
They played ball. And in exchange, they were paying very low tariff rates, maybe 2%, maybe 0. They were fully inside the circle of trust.
They thought they were safe from the crossfire.
And today, Section 122 says, sorry, no favorites allowed. They are all reset to the new global baseline of 15%. Their costs just skyrocketed overnight.
Wow.
Take the UK economy. It's already fragile. They're dealing with their own sticky inflation issues. And they just got hit with a massive new tax on all their exports to the U.S.
So being a friend of the United States just got 15% more expensive. That is really awkward diplomatically.
To put it mildly, the EU came out today with a furious statement. They literally said a deal is a deal. Yeah, they are flat out rejecting the hikes. They're arguing you can't just override a modern bilateral treaty with some obscure 1974 trade law. But the White House is just saying, watch us. Section 122 is the law of the land.
Okay, so our allies are the losers in this scenario. They get a huge unexpected tax hike. So who are the winners? And obviously I use winners with heavy air quotes here because nobody really wins a global trade war.
Yeah.
But relatively speaking, who benefits from this specific law?
The winners are the exact countries Trump has been actively trying to punish. China, Brazil, Canada.
Wait, how does that math work? I thought the whole point of this was to crush China with tariffs.
We were trying to. Prior to this weekend, China was facing incredibly punitive targeted tariffs. We're talking 60% on general goods, 100% on electric vehicles, massive duties on steel and aluminum.
The China wall, right.
Right, specific targeted pain designed to force a decoupling of the two economies. But under the non-discriminatory rule of Section 122, you can't single them out anymore.
Oh, well.
You can't have a China-specific rate that is higher than the UK rate. So by law, their rate actually drops to the new global baseline of 15%.
Wait, let me get this straight. So China actually gets a massive tax cut out of this.
Effectively, yes. At least for the next 150 days while this emergency order is active.
That is insane.
Capital Economics called it something of an FU to our allies. But in reality, it's just a legal box the administration painted themselves into. The president effectively had to lower the wall for his enemies just so he could build a fence for his friends.
That is wild. It is completely counterintuitive. No wonder the market is so confused today. I mean, corporate supply chains rely entirely on predictability.
Exactly.
You can't plan your inventory or your pricing if you don't know if your tariff on a part is going to be 0% or 60% or 15% from one day to the next.
Spot on. It's not just the absolute cost of the tariff that hurts, it's the chaos. Imagine you are a supply chain manager at Apple or Walmart. Yesterday, your spreadsheet projections said one thing. Today, your inputs from Vietnam are suddenly up 15%. Your inputs from China are down 45%. And your inputs from Europe are up 15%.
You'd have to tear up the entire projection.
You're flying blind.
Yeah.
And when there is chaos and zero forward visibility, money flees to safety. That's why we saw a massive flight to quality across the board today.
Let's look at where that money actually went, because it certainly didn't stay in equities.
It went straight into treasuries. The 10-year yield just collapsed today. It fell 6 basis points down to 4.01%.
Huge move.
That is big institutional money looking at the board and saying, I don't care about return on investment right now. I just want return of my investment.
Right, capital preservation mode.
Exactly. They are parking billions in government bonds, betting that this tariff chaos is going to severely slow down global growth. And lower growth means lower inflation demand down the line, which means lower bond yields.
And gold. Gold is really having a moment right now.
Gold is shining brightly. It hit a 3-week high today, hovering right near $5,230 an ounce.
Man.
It's up a 19% year to date. When investors lose faith in policy stability, when they feel like the fundamental rules of the game are changing every 24 hours, they buy the barbarous relic.
Yep.
They buy the one thing that no politician can print and no obscure trade act can debase.
It's interesting, though. Gold is clearly acting as the ultimate safety trade right now, but silver isn't coming along for the ride. Usually you see those two move pretty much in tandem.
And that is a really key distinction that smart macro traders are noticing today. Wall Street is actively urging caution on silver.
What the divergence?
Because silver is a hybrid asset. It's half monetary metal, half industrial commodity. It goes into solar panels, electric vehicles, medical devices, all sorts of electronics.
So if the factories slow down...
Exactly. If the global economy slows down because of this tariff war, the industrial demand for silver drops significantly. Gold is a pure fear play. Silver is exposed to the recession risk, so gold is breaking away and leaving silver behind.
Makes total sense. And then there's the other asset class. The one that has spent the last decade screaming from the rooftops that it is the new digital gold. Crypto. Specifically Bitcoin.
Yeah, Bitcoin did not get the safe haven memo today.
It dumped. I mean, it was down over 4% to around 64,000. If the core thesis of crypto is that Bitcoin is a hedge against government incompetence and fiat inflation, today should have been its absolute Super Bowl.
You'd think so.
I mean, the government looks highly incompetent. Global trade is a messy disaster. Why isn't Bitcoin mooning right now?
Because the marketing narrative and the actual market reality are completely disconnected. The reality is that Bitcoin trades like a high beta tech stock. It essentially trades like a leveraged bet on the NASDAQ. When the NASDAQ drops, Bitcoin drops harder. It is firmly a risk-on asset, not a risk-off asset. It needs excess market liquidity to go up, and when liquidity dries up because everyone is scared of a trade war, crypto tanks.
And we are seeing the big institutions vote with their feet on this. I saw the outflow data on Brevin Howard today. That is a serious heavyweight macro hedge fund. We're not talking about day traders on Reddit here.
It wasn't just a sell-off, it was an evacuation. Brevin Howard sold 86% of their Bitcoin ETF position.
86%.
They went from holding $2.4 billion in the IBIT Trust down to just $275 million.
That isn't a trim to rebalance a portfolio. That is a get me out at absolutely any price kind of panic.
It is. And when a whale of that size sells, it creates a massive vacuum in the order book. It tells you unequivocally that the smart money does not view Bitcoin as a place to hide during a trade war.
Right.
They view it as a liquidity source. When margins get tight and things get scary, you sell what is highly liquid. And right now, those Bitcoin ETFs are very liquid, so they hit the bid hard.
Okay, so that covers the macro side of the bloodbath. It's a total mess. Tariffs are back, our allies are hurt, our rivals get a temporary break, and everyone is hiding under their desks in bonds and gold.
Yeah.
But honestly, that wasn't even the thing that scared me the most today.
Really?
No. The thing that really made me pause, the thing that felt like a glimpse into a very, very scary future, was this Citrini narrative, the AI panic. Because this feels different. This doesn't feel like a normal cyclical downturn. This feels like an existential crisis for the entire tech services sector.
You're talking about the Syspocalypse revisited. It is a fascinating psychological shift we're seeing.
So for the listeners who might have missed this over the weekend while they were touching grass, break down the catalyst for us. It started with a research note, right?
Yes. A really detailed research note from Citrini Research, led by James Van Gielen. It dropped over the weekend and just went absolutely viral on financial Twitter and across all the trading desks.
And the premise of this note literally sounds like the plot of a sci-fi novel.
It does, but a very grounded one. The note describes a specific scenario set in June of 2028, so we are talking just over 2 years from now.
Right around the corner.
Exactly. It's not some distant 22nd century future. It envisions a world completely dominated by agentic AI.
And agentic AI. We hear that term thrown around a lot lately. Define what that means in this specific context.
Sure. So most people today think of AI as essentially a really smart chatbot. You ask ChatGPT to write a poem or summarize a long email thread.
Right.
That is passive AI. It waits for your prompt, gives an output, and stops. Agentic AI is software that actually does things in the real world. It has agency, it can plan multiple steps, execute actions, and negotiate on your behalf without you holding its hand.
Okay. So instead of me asking the AI to suggest a dinner menu, I literally just tell my AI, hey, get me dinner.
Exactly. And this is where the Citrini thesis gets absolutely terrifying for anyone who makes a living as a digital middleman.
Okay.
The idea is that these AI agents will soon be able to negotiate directly between consumers and underlying services, completely bypassing the friction and the massive fees of the current app economy.
Let's make this really concrete for people. Today, if I want a pizza, I pull out my phone and open DoorDash. I scroll past a bunch of sponsored ads. I pick a restaurant. I pay a delivery fee, a service fee, a small order fee. And DoorDash takes maybe a 30% cut directly from the restaurant. It is a very expensive, friction-heavy process for everyone involved except DoorDash.
Right. But you pay it because it's convenient. You don't want to call the restaurant, read them your credit card number, and you don't want to drive there. DoorDash owns the interface, so they get to extract the rent.
So in the Citrini world, in 2028, how does that exact transaction change?
In that world, you don't use the DoorDash app at all. In fact, the app might not even exist on your phone. You just speak to your personal AI agent on your device. You say, get me a pepperoni pizza from that place on 5th Street for under $20.
And what actually happens in the background?
Your AI sends a direct protocol message to the restaurant's AI system. It says, order, 1 pepperoni, offer, $18. The restaurant's AI instantly analyzes its ingredient costs and current oven capacity and accepts the bid.
Wow.
Then your AI instantly pings a decentralized network of drivers. Maybe it's local gig workers, maybe it's delivery drones, maybe it's an autonomous Waymo vehicle. It negotiates the route and hires the driver directly.
So where is DoorDash in this loop?
DoorDash is nowhere.
Yeah.
They're entirely cut out. Citrini calls this the rise of vibe-coded alternatives replacing the established brand.
Vibe code?
Yeah. Why do I need the DoorDash interface if my AI handles all the logistics flawlessly in the background? The entire moat of a company like DoorDash or Uber Eats is that they aggregate the restaurants and the drivers in one place. But if an AI protocol can aggregate them instantly on the fly for zero cost, the moat evaporates.
And man, that narrative clearly hit the panic button for the market today. Just look at the delivery stocks. DoorDash was down 7.2%. Uber was down 4.5%. The market is suddenly realizing that their impenetrable moat might just be a temporary user interface.
And if the interface goes away, the cash flow dries up. But the panic wasn't just contained to food delivery. It hit the payment sector even harder. And this is the part that really blew my mind today. American Express, down 7%.
That is a legitimate crash for stock like Amex. That is a terrible earnings report kind of drop, but they didn't even report earnings today. They just got caught in the narrative crossfire.
Visa was down 3%, Affirm was down 6%, because the logic of the Citrini note extends directly to payments.
Right.
If AI agents are the ones settling the ledgers directly between buyer and seller, do you really need the legacy Visa network rails? Do you need to pay that 3% interchange fee that funds everyone's credit card reward points?
Or does the AI just settle the payment wallet to wallet on a low-cost crypto rail? Or the FedNow rail instantly?
Exactly. Citrini talks extensively about the death of the middleman. If an AI can verify the transaction instantly, securely, and for fractions of a penny, the traditional toll collectors, Visa, Amex, Stripe, just get bypassed entirely.
Wow.
The market is suddenly trying to price in a future where AI efficiency ruthlessly squeezes every ounce of profit out of transactional friction.
It makes a lot of sense when you think about it. I mean, American Express relies heavily on prestige. They rely on the physical act of you pulling that heavy metal platinum card out of your wallet at a fancy dinner to impress your date or your clients.
Right, the flex.
But if your AI agent just pays the bill seamlessly in the background while you're walking out the door, nobody ever sees the card. The physical brand value basically evaporates to zero.
That is exactly the fear. It's the total commoditization of the transaction layer. And today, the market decided to price that existential risk in violently.
But notice the outliers here, because this is where the trading puzzle gets really interesting. PayPal was up over 7% today.
Yeah, that was definitely the biggest head-scratcher of the session.
I mean, everything else in fintech is burning to the ground, and PayPal is rallying. Is there something in the thesis we are missing?
There are two main theories circulating on the trading desks today about PayPal. The first is that PayPal is currently viewed more as the underlying plumbing, the actual digital wallet, rather than just a branded card network.
Okay.
In a world of autonomous AI agents, you still need a secure digital vault to actually hold the funds being transacted. Maybe the market thinks PayPal is well positioned to be that vault because of its massive existing user base and the Venmo integration.
That makes sense. What's the other theory?
The other theory is that it's just a mechanical sector rotation. You have algorithmic traders aggressively selling the high-flying winners like Amex, which has been on an absolute terror lately, and looking for somewhere to park that capital.
So they buy the beaten down dog like PayPal.
Exactly. A classic datch for trash rally. Sometimes the market isn't making a grand philosophical statement, it's just balancing the books.
Fair enough. But the much more compelling outlier to me today is Apple. Apple held up incredibly well. They're up almost 6% over the past month, and they held perfectly steady today while Microsoft and Google were really struggling.
This is the CapEx defense in action. We've talked about this dynamic before on the deep dive. Microsoft, Amazon, Google, they are locked in a brutal arms race right now. They are spending a collective estimated $665 billion on data centers.
It's staggering.
They are burning mountains of cash just to build the foundational AI infrastructure.
And Apple is just sitting on its hands.
Apple is pulling the ultimate work smarter, not harder move. They are happily letting everyone else bankrupt themselves, building the chips and the server farms. Apple's bet is remarkably simple. We own the user. We own the iPhone.
Right, because in a Citrini world, where does that personal AI agent actually live? It lives on my personal device.
Exactly. And who owns the device? Apple does. So Apple naturally becomes the ultimate gatekeeper for all these agents. They don't need to spend $1 trillion building the smartest artificial brain. They just need to control the door that the brain has to walk through to reach the consumer.
And they will definitely charge a toll at that door.
Oh, absolutely. And the market just loves that capital efficiency right now. Apple isn't spending $100 billion a year to compete in the mud. They're just sitting back waiting to tax whoever wins.
Brilliant. Now, there was one more major victim of this AI panic today that we definitely have to mention, IBM.
Oh, man. IBM just got slaughtered today, down 13%. That is a massive structural move for a legacy blue chip stock like that.
And this drop was directly tied to a specific news item from Anthropic, right?
Yes, it was. Anthropic announced a new, highly advanced AI tool that is specifically designed to automate complex, multi-step business analysis. We are talking about the exact bread and butter work of massive management consulting firms.
The consultant killer.
Exactly. Think about what IBM actually does today. People think of them as a hardware company, but they really aren't anymore. They're a massive white-collar services and consulting company.
Right.
They charge Fortune 500 companies $500 an hour for a junior consultant to sit in a conference room, analyze a supply chain, audit some financial systems, and eventually make a massive PowerPoint deck.
And Anthropic just released a tool that can do all of that analysis in 30 seconds for about 10 cents in compute costs.
Precisely. If an AI can accurately analyze your internal business logic and audit your corporate systems securely, why on earth are you paying IBM or Accenture or Cognizant billions of dollars a year in retainer fees?
You wouldn't.
You wouldn't. And the market looked at IBM today and basically saw a dinosaur staring up at a rapidly approaching meteor. Accenture and Cognizant were down heavily today, too.
Wow.
The market is waking up to the fact that high-end white-collar services are the immediate next target for severe AI disruption. It isn't just graphic artists and copywriters anymore. It is the MBA crowd.
It really feels like we are watching the market try to accurately price in a sci-fi novel in real time. It's panic selling based on a hypothetical future that is still 2 years away.
It is, but, that's what efficient markets are supposed to do. They discount the future into the present price. And right now, that future looks incredibly deflationary for anyone whose business model is charging a toll to sit in the middle of a transaction or a data flow.
All right, so we have the tariffs hammering the macro picture. We have AI existential dread hitting the tech and services sector. And then we have the third major pillar of today's sell-off, private credit.
Yeah.
And honestly, this one feels a little more immediate to me, a little less sci-fi and a lot more, 2008 financial crisis.
This is the one that actually keeps me up at night. The other two are systemic shifts, sure, but this one is a visible structural crack forming in the foundation.
Right.
Private credit has been the absolute darling of Wall Street for the last few years. It represents roughly $1.8 trillion in loans that are made by non-bank shadow lenders.
Right. And we actually talked just last week about Blue Owl, capital ticker OWL. They announced they were halting the quarterly redemption optionality for one of their major funds, OBDC2.
Which, just to translate that, is fancy corporate speak for the Hotel California.
You can check in, but you can't check out.
Exactly. You can give us your money, but you cannot have it back right now.
That is never a sentence you want to hear from your asset manager.
No, it's terrifying because liquidity in financial markets is exactly like oxygen. You literally don't even notice it's there until it's gone, and then it's the only thing that matters.
Yep.
When a major fund suddenly says you can't withdraw your own capital, it almost always means the underlying assets are illiquid, or worse, impaired, and they physically don't have the cash on hand to pay out the redemptions.
And today, the stock for Blue Owl fell another 3.4%, dropping about 5% intraday. But the real story here was the Treasury Secretary, Scott Bessent.
Oh, yeah, he did not mince words.
No, he didn't. He was asked directly about Blue Owl and the broader private credit sector on Friday, and his quote was just chilling.
He said, quote, "We are concerned," which, is the polite diplomatic part. But then he just dropped the hammer on them. He said, if there is something rotten, it is not going to be handed to the individual investors.
Rotten.
Rotten.
You do not hear a sitting U.S. Treasury Secretary use the word rotten lightly. He is clearly signaling that the government is seeing some serious potential toxicity deep inside these loan books.
And the regulatory context here is absolutely crucial to understand why he said that. Why did he specifically mention individual investors?
Right. Why retail?
Because is what happened last summer. President Trump signed an executive order explicitly allowing private credit funds to be included in 401ks and retail brokerage account.
Right. Because historically, this used to be an exclusive playground for billionaires, sovereign wealth funds, and giant pension funds. Highly sophisticated investors who can afford to lock up capital for 10 years. Now suddenly, it's sitting inside your standard target date retirement fund.
Exactly. So when Bessent comes out and says it won't be handed to individual investors, he's trying to talk tough to Wall Street. He's implying there won't be a government bailout. He's saying, if you guys messed up the underwriting, you own the loss. But if this stuff is already baked into retail retirement accounts across the country, the contagion is already there. The individual investor is already holding the bag.
It feels like Bank of America didn't quite get the memo on the panic, though. They came out with a massive defense today. They issued a note basically saying, nothing to see here. It's all just market misinformation.
Yeah, BofA is practically pounding the table on this one. They reiterated a $24 price target on Blue Owl, which implies the stock is going to double from here.
Wow.
The CEO of Blue Owl, Mark Lipschultz, was out there calling these concerns green flags, arguing the credit quality is perfectly fine.
Green flags.
Mm-hmm.
The Treasury Secretary uses the word rotten, and the bank says green flags.
Mm-hmm.
Who is the retail investor supposed to believe here?
Look, in a credit cycle turn, you always look at the liquidity, not the rhetoric. If a fund forcibly stops you from withdrawing your own money, that is never, ever a green flag. I don't care what the internal loan book says on paper.
Exactly.
If you can't cash out, it's a massive problem. BofA might be looking at the high yield of the loans and the theoretical mark-to-model value, but the broader market is looking at the severe liquidity risk.
It really feels like BofA is trying to catch a falling knife here.
Or they are just structurally incentivized to look at the yield and ignore the tail risk. Remember, the modern private credit industry has never actually been tested in a real sustained recession.
Good point.
It has grown from basically nothing after 2008 to $1.8 trillion, mostly in a zero interest rate or at least highly stable macroeconomic environment. We are about to find out in real time what happens when these heavily leveraged corporate borrowers suddenly can't refinance their debt in a higher for longer rate environment.
Okay, so you have three massive systemic headwinds all converging on a random Monday afternoon in February. You have tariffs choking the macro, AI disrupting the tech and services moat, and shadow credit wobbling in the background.
It's a lot.
It is a lot, but, and there was always a but on this show. There's one major stock that was actually green today. One company that seems to just completely defy financial gravity.
Nvidia.
The king, NVDA, was actually up 0.91% today. And that's not a huge face-ripping rally, but on a day where the Dow drops 800 points and everything else is bleeding, green is absolute gold.
Incredible relative strength.
And they have earnings coming up this Wednesday after the ball.
This is undoubtedly the most fascinating setup of the week, maybe of the entire year. Everyone on Earth knows Nvidia is the absolute center of the AI universe. But let's look at the actual valuation for a second.
This is the bizarre valuation setup we teased in the intro. You would naturally think, with all this insane AI hype, with companies spending hundreds of billions on their chips, that Nvidia would be trading at some astronomical multiple, like 100 times earnings.
It's trading at 23 times forward earnings.
23. That is, honestly, that's boring. That is like a consumer packaged goods company valuation.
Yeah.
A soup company trades at 23.
It is its lowest valuation in 5 full years. It is currently cheaper than AMD. It is cheaper than Broadcom. It is trading at a massive, massive discount to its own 9-year median PE ratio, which sits around 35 times.
How is that even mathematically possible? They are literally printing money. They have a virtual monopoly on the H100s, the Blackwell architecture, the upcoming Rubins. They're the only game in town. Why on earth is it priced so cheap?
It comes down to a concept called duration repricing. Institutional investors aren't asking, is AI real anymore? They know it's real. Citrini just told us it's real.
Right.
What they are asking is, how long does the hardware spending party actually last? The market is absolutely terrified of what they're calling the 2026 cliff.
The cliff. Explain
Yeah.
the mechanics of that fear.
The bearish theory goes like this. Google, Microsoft, Meta, the hyperscalers, they are buying literally every single GPU they can find right now. They are double ordering, they are triple ordering just to secure their place in line.
Building the infrastructure.
Right. But eventually, they will have enough chips. Eventually, the massive multi-gigawatt data centers are fully built out.
Yeah.
And when that day comes, new demand for NVIDIA chips drops off a cliff.
It's a cyclical fear. The idea that this is a massive construction boom, and once the skyscraper is finally built, all the carpenters and steel workers get fired.
Exactly. So the market is pricing NVIDIA right now as if its earnings are about to permanently peak and then collapse in 2027. They think we are at peak earnings right now, hence the low forward multiple.
But there's also a huge technical factor at play here too, right? The law of large numbers.
This is huge, and a lot of retail traders miss it. NVIDIA's is currently 7.4% of the entire S&P 500 index. It is the heaviest single weighting in the index.
That is just an enormous concentration of capital in one ticker.
It is actually too big for the financial plumbing to handle. Most active mutual funds and institutional ETFs have strict charters legal rules that explicitly cap their maximum exposure to any single stock at 5% or maybe 7%.
Oh, wow. So even if a portfolio manager absolutely loves Nvidia's fundamentals,
He has to sell it. As Nvidia's stock price goes up, he becomes a forced seller just to stay legally compliant with his own fund's diversification rules.
that's crazy.
It creates a massive natural structural headwind that compresses the valuation multiple. It simply cannot go much higher in terms of index weighting without breaking the diversification rules of the entire global asset management industry.
Okay, but the actual underlying fundamentals of the ship market are still screaming buy. Did you see the news out of Asia about Samsung this morning?
I did. Samsung is aggressively raising their prices on HBM4 memory chips by 30% across the board. They are citing severe supply shortages.
And just for context, HBM4 is the high bandwidth memory that Nvidia desperately needs to package alongside its GPUs.
Correct. You literally cannot build or run a next-generation Blackwell chip without a ton of HBM4 memory attached to it.
Right.
If Samsung is successfully raising prices by 30% just because of a shortage, that tells you underlying demand is still red hot. It tells you the feared 2026 cliff definitely isn't here yet. The hyperscalers are clearly still buying everything they can get their hands on at any price.
And this creates a really interesting secondary dynamic in the market today. Samsung stock is hitting all-time highs because they clearly have tremendous pricing power right now. But this dynamic actually hurts Apple.
It does, because Apple relies on Samsung for roughly 60% of its device memory components.
Yeah.
If global memory chips suddenly get 30% more expensive, Apple's hardware profit margins get seriously squeezed.
Wow.
So it just goes to show you that the picks and shovels trade, the companies making the actual physical silicon, are still the ones commanding all the leverage in the tech ecosystem.
All right, so let's bring this all together. We have painted a very vivid picture of the landscape today. The macro picture is ugly with these new tariffs. The tech services sector is panicking over AI agents. Private credit is wobbling ominously.
Yep.
But Nvidia is sitting there dirt cheap, and across the board, implied volatility is absolutely skyrocketing.
And this is exactly where the Theta fuse mindset finally kicks in.
Let's talk actual trading strategy. How do we capitalize on this mess?
Well, when FAR is this high, options premiums are historically expensive. We want to be sellers of premium. We want to be the casino, not the gambler pulling the lever.
Let's look specifically at Nvidia, since earnings are Wednesday.
Look at Nvidia sitting at 23 times forward earnings. If you are a long-term believer in the AI secular trend, that valuation is an absolute bargain. But because earnings are on Wednesday and the market dropped 800 points today, the options premiums on Nvidia are wildly inflated.
Everyone is terrified.
Everyone is buying puts to protect their long portfolios, which drives the price of those put options through the roof.
So you like the cash-secured put strategy here?
I absolutely love it here. Here is the exact play for a Theta fuse trader. You sell a put option on Nvidia with a strike price maybe 10 or 15% below the current market price.
Okay.
Let's say the stock is trading around $190. You sell the $170 put. You collect a massive cash premium upfront today purely because fear is so high.
And the mechanical logic here is, if Nvidia somehow crashes after earnings and drops all the way down to 160, you are legally obligated to buy the stock at 170.
Right. But remember, you get to keep that massive premium you collected today, so your actual break-even cost basis is much lower. It might be down around 162 or something.
Nice.
You are basically telling the market, I am more than happy to buy Nvidia at a steep discount, and I demand that you pay me a fat yield while I wait for it to drop.
And what if Nvidia reports a blowout quarter and the stock rallies?
Then the put option you sold just expires completely worthless. You keep the entire premium as pure profit. It is a fantastic win-win scenario, assuming, and this is a big if, assuming you are fundamentally bullish on the long-term value of the underlying company. You are literally turning the market's blind panic into your weekly paycheck.
Capitalizing on the fear. I love that. Now, what about the Citrini panic names? The delivery stocks like DoorDash, the payment stocks like Amex. Are those drops a buying opportunity today?
I would be extremely careful with the companies sitting directly in the crosshairs of that thesis, like DoorDash or Uber. That agentic AI narrative is incredibly sticky, and it makes logical sense.
It does.
But for the broader big tech complex that sold off in sympathy today, this is where I start looking very closely at LEPs.
LEPs, long-term equity anticipation securities. For those who don't trade them, these are basically just standard call options, but with expiration dates pushed way out, like a year or two into the future.
Right. If you firmly believe this whole AI panic is overblown in the short term, if you think Microsoft and Google aren't going to have their entire business models replaced by a rogue AI agent in the next 6 months, you can step in and buy deep in the money call options expiring in 2027 or 2028.
Why use LEPs specifically instead of just buying the stock or short-term calls?
Because of Theta. Short-term options suffer from rapid Theta time decay.
Right.
Every day you hold them, they lose value. But with LEPs, you are buying a massive amount of time. You are placing a leveraged bet that the market will eventually come to its senses, and you get the massive upside leverage of an option contract without the daily stress of needing the stock to bounce back tomorrow morning.
Okay, so the playbook is sell puts on high-quality names like Nvidia to harvest that rich volatility premium. Buy LEPs on the beaten-down tech giants if you have a strong stomach for the rebound.
Exactly.
What are we staying completely away from? What is on the absolute do-not-touch list for this week?
The stay-away list is actually pretty clear today. First and foremost, crypto.
Really? Even
Yeah.
with the big dip today, usually people love to buy the crypto dips.
Especially with the dip today. Look, when you see sophisticated macro hedge funds like Brevin Howard exiting stage left, and you see Bitcoin falling in lockstep with the NASDAQ instead of hedging against it, the core investment thesis is broken for the moment.
Fair point.
Let the dust settle. Do not try to catch that falling knife until we see it genuinely decouple from broader tech equities.
Next on the list to avoid, airlines.
Yeah, this is just pure tactical bad luck. Winter Storm Hernando is absolutely pounding the Northeast right now. JFK and LaGuardia are basically frozen parking lots.
I saw the pictures. It looks miserable.
Thousands of flights canceled. United and Delta were both down around 4% today. Do not try to be a hero and buy that dip until the snow physically melts. It is just dead money for at least a few weeks while they sort out the logistics.
And finally, SaaS, the traditional software as a service companies.
This is a major technical breakdown. The IGV ETF, which is the benchmark that tracks software stocks, broke down through a massive technical support level at $76 today.
Oh, man.
It is entering what technical analysts call a no-bid zone. Legacy companies like Workday and Adobe are now trading at pandemic-era lows.
Wow.
The Citrini narrative hurts them the most. If a cheap AI agent can replace the expensive software seat license, their entire recurring revenue model just implodes. Stay far away from SaaS until we see a definitive technical floor form.
Man, it is a lot to digest. But, that is exactly why we do this. We unpack the fear, look at the data, so you can actually find the opportunity.
Knowledge conquers fear. Or, at the very least, it helps you hedge your portfolio against it properly.
Exactly. Now, before we wrap this deep dive up, I really want to leave you, the listener, with one final provocative thought. Something for you to just chew on while you're watching the futures markets tonight.
Oh, I love these. Let's hear it.
We talked earlier about Treasury Secretary Bessent. He said if private credit rots, quote, it is not going to be handed to the individual investors.
Right, meaning no taxpayer bailout for the wealthy fund managers.
Right. It's tough talk. Very principled free market talk.
Very.
But I want you to really think about President Trump's executive order from last summer. That order specifically paved the way for those exact private credit funds to enter mainstream 401ks and standard retirement accounts. It quite literally put the quote-unquote rot directly into the hands of the average retail investor.
Yes. I see exactly where you were going with this.
So, if the shadow credit market actually cracks, and suddenly grandma's pension and the middle class's 401ks are directly on the line, the government has to bail it out, right? The political pressure would be absolutely insurmountable.
It would be complete political suicide for any administration to just let the middle-class retirement system fail.
Exactly. So aren't they essentially just setting up a massive bailout for the shadow banks, the billionaires who actually run these highly leveraged funds, and using the everyday retail retirees as the ultimate human shield to politically justify the money printing?
That is the ultimate Wall Street sleight of hand, isn't it? Privatize the massive gains during the boom, socialize the catastrophic losses during the bust, and use the most vulnerable demographic as the bulletproof excuse to turn the money printers back on.
Exactly. Are we just looking at a backdoor bailout of the shadow banking system, perfectly disguised as protection for grandma?
It is a genuinely terrifying thought, and if Bessent is publicly saying he's concerned, we should probably all be paying very, very close attention to what they do next, not just what they say.
On that cheery note,
Yeah.
keep your powder dry, keep a very close eye on that implied volatility, And we will see you on the other side of the Nvidia earnings report.
Stay sharp out there, everyone.
This has been The Deep Dive. Thanks for listening.